Okay. Hello, my name is Elise Hatton and I am the Smart Hub Business Manager. And it is my pleasure to welcome you today to our July, wow, I'm getting ahead of myself, our June Lunch and Learn. Can you believe that there are only 7 days until the end of this financial year? That is amazing to me. I can't believe that the second and the third quarter of this financial year has gone so quickly. So traditionally in June, we always host a lunch and learn to speak about tax and how you can save tax. And that is exactly what we're doing again today. So I would love to welcome Peter Shonhan from Canar's Chartered Accountants to share with us what we can do to legally minimize the amount of tax that we need to pay. Now, as you all know, I never read the marketing to you, so I'm not going to read Peter's bio or introduce him via what you've already read about him. What I am going to do is, or what I do want to do is to share a quirky fact about Peter. So when I asked Peter to tell me a quirky fact about himself, he's like, what? We're accountants. I'm not quirky at all. So what Peter likes to do on the weekend is he likes to hang out with his kids at the beach. And I don't, even though that's not quirky, I think that's pretty cool. Peter, thank you so much for joining us today. Thank you for sharing your information with us. We really appreciate it. As always, we'll be taking questions at the end. If you're on the Zoom session, please feel free to put your questions in the chat, or you can just speak up, raise your hand and speak up. If you're joining us via Facebook, please feel free to put your questions in the comments. We will be able to answer those questions as well. And as always, I always say, try and take away 1 or 2 or 3 things that you can implement in your business straight away that will make a difference. So Peter, tax, end of tax year, what do we do? How can we legally save tax?
Thanks, Elise. Well, there's quite a fair bit we can do, even in a short space of time. There's only 6 actual working days until the end of financial year. Including today, so 8 including today if you include the weekend. So there's quite a fair bit that we can do between now and then to really get our house in order. Essentially what we can do is review where we're at the moment and what we can do to save some tax to really bring down our year-end tax bill for this year, or work out where our tax position is and what we can do in future years as well to ensure that we're paying as least tax as possible. Sometimes, yes, it involves spending money to save tax. Other times it's just internal things that you can do, such as review your business structure, which we'll go through today, the timing of your tax payments, or just how you run your business in general can really save you tax and save you money without even actually having to spend anything, which I think is pretty cool, and which is what we generally try and do from a business point of view as well. So I've got a presentation. It'll probably take about half an hour. And then along the way, if everyone can just send in their tax questions to me, or if they've got any ideas that they want to run past me, more than happy to answer them as well. And also, if you've got any questions about the presentation, just yell out also. So what I'll do. So you can see my screen there, okay? That's no dramas at all. Yep. Okay, cool. So end of financial year tax tips. Most important thing to do before we go about saying, I need to save tax, I need to do all this stuff at the end of the financial year very quickly, know where your numbers are at. Especially this year, there may be a case where you don't actually need to do any tax planning in the 2020 financial year due to everything that's happened with COVID, business shutdowns, tax policies that are changed, etc., etc. And it may be more advantageous to save for next year and do something on the 1st of July or the first week of July. So always make sure you know your numbers and know where your tax situation is at all times. So gaining an understanding of your current situation by reviewing your numbers, having an accountant to review your numbers or your financial officer to review your numbers, and then projecting out what your taxable income will be for this year and your tax position is. Doing that before the 30th of June will allow you to make decisions that can save you tax in this year. If we come to August or September and you're reviewing your tax situation, it's too late. We can't do anything about it, and what's happened's happened. So being proactive is the #1 tax tip that we can give to all of our clients, which doesn't cost you any money. Know where you're at now and know the tools that are available to you in order to save as much tax as you can in this financial year. Before I wanted to go any further with specific, I guess, tools that we do use, there's a couple of things that are most asked questions from accountants about general deduction claims. So for example, motor vehicles. Everyone asks us, what can I claim on my motor vehicle? And how much can I claim on my motor vehicle? So with regards to motor vehicle claims, there's two ways that we can claim your motor vehicle. If you own it personally, we can claim it on a cents per kilometre basis for any trips that you've used for work, purposes only, so not to and from work. And we can claim up to 5,000 kilometres at a rate which is 68 cents per kilometre in this financial year, and it's soon to go up to 70 cents per kilometre in the next financial year. So that's a very easy way. You'll still have to document what you've done and show the tax office if you get asked how you've calculated the mileage on your motor vehicle. But it's not as onerous as filling out a logbook for your motor vehicle. The positive with filling out a logbook for your motor vehicle, however, is that we're able to do it over a 3-month period, and we can claim whatever percentage business use of your total running expenses are applicable to your motor vehicle. So if you're running around out west or going to Brisbane or up to Mackay a fair bit for work, your actual running expenses are going to be a lot more than what the actual rate that the tax office allows you to claim is. So we recommend most clients use a logbook if you're doing heavy motor vehicle usage for work purposes or for business purposes, and that just protects you from any tax audits or tax questions that you may receive from the tax office in the future. With logbooks, always make sure that they're reviewed every 5 years. It's a common trap that a lot of people have. If you haven't done a logbook for quite some time, it's always a good thing to review your logbook to make sure that your business use is appropriate and that you may need to get another logbook done up. It's a very easy way to save some tax by claiming more on your motor vehicle usage legitimately without actually spending any more money, just by rearranging your affairs and how you do them from a motor vehicle point of view. The other thing that we find a lot of clients don't do as well as what they should have, and they're clients of ours, but also people out in the world in general, is receipt capture. Now, I was probably one of the worst for these, and I'm an accountant. I was probably one of the worst for these before technology came along on board. I'd go and buy something, have the receipt, yep, top drawer, off you go. But these days, there's a lot of receipt capturing apps that you can use to record your receipts. So the ATO has a good receipts tracker where you take a photo of it and you can categorize it into different types of expenses that are claimed. If you have a business, you can use an app such as HubDoc or Receipt Bank or Xero. They're very low cost, but they do allow you to file your receipts electronically and up in the cloud without having to go and store them in folders, etc. The biggest other issue we have with receipts is that they generally tend to smudge. I'm sure everyone's aware of that. So if you're trying to keep records from a tax perspective for 5 years or more, it's very hard to with receipts taken from office work. So having them scanned in or taken a photo and put into a program is a lot more efficient than keeping them in a folder. And just make sure that you're claiming everything that you're spending money on. And those little things aren't getting, I guess, missed. The same goes for travel expenses with regards to your individual tax return, or if you're in a business. If you're away on business, make sure you're claiming everything that you possibly can with regards to travel. So we're talking about taxis, meals, accommodation, flights, anything that's in relation to that business travel. Common question I get asked, or is usually on the receipts, is a bit of alcohol that's spent with dining. General rule is alcohol's non-deductible, so just keep that in the back of your mind if you are traveling to keep that receipt a bit separate as well. The other thing that's been quite well advertised at the moment is the home office expenses concessions that have been made by the ATO. There were some new rules that came out with regards to COVID, whereby the ATO would give you a home office rate for each hour that you've spent at home whilst working. So there's two rates this financial year. I haven't got them up on my screen, but there is an increased rate from the 12th of March onwards, which was when people were starting to come home from COVID purposes. And that just allows you to easily claim all of your home expenses in one rate, multiplied by the number of hours you worked from home. So it's always a good idea to keep a log of the amount of hours that you do from home, so that you are able to claim a per rate basis. So it's so many cents per hour for the amount of time that you spent at home. That just covers off general things like electricity, telephone, general wear and tear in the house, etc., without having to really go into a lot of record keeping around your home expenses from there. Another thing that we generally tend to find that people don't record so well is telephones, like mobile phones. I have a mobile phone that I use for work quite a fair bit. I'm sure everyone on the call does as well. But make sure you keep an appropriate percentage for private use and business use of your mobile phones, and make sure you store those tax invoices that come through Telstra as well, so that you're able to claim the most that you possibly can from a mobile phone and internet point of view. Common question is, well, how much can I claim? Generally take a look at a week in the life of you, how much time you spend on your phone for work versus how much time you spend on for Facebook or ringing the kids or what have you, and come up with a percentage that you think is reasonable. Now you can also go into your phone bill and it can track what calls you've made. So you can look at what calls have been made for work or for personal, and that'll give you a bit of an idea as to how much time you spend on the phone for work rather than for private use. I've also gone into people's phones before, obviously with their permission, and had a look at what their time usage is on certain apps. So that will give you a bit of an idea as well as to how much time you're spending on different facets of your telephone, so that we can claim the maximum we can out of that. The big thing that happened with regards to obviously COVID and the tax concessions which were made by the government was an increase in the instant asset write-off, or the immediate deduction for assets that are purchased by businesses. So you have to have them installed ready for use by the 30th of June 2020 to claim them as a tax deduction in this financial year. So be very careful with that if you go out and buy a motor vehicle today from the people down the road here, for example, you actually have to take delivery of the car and it has to be ready for use and used by you to claim a deduction in this year. Simply having a piece of equipment on order and not being installed ready for use won't allow you to claim a deduction this year, but it will let you claim a deduction next year. The assets claimed up to $150,000 has been extended to the 31st of December. So if you miss out this year, you can still purchase any assets up to $150,000 and claim a tax deduction for it immediately in the next financial year, but providing it has been installed ready for use by the 31st of December 2020. So instant asset write-off's fantastic for business as far as getting immediate deduction or immediate tax relief for anything that you buy. We just need to make sure that it's actually installed ready for use in the period which we want it to occur in. If you've got bigger pieces of equipment, for example, I've got plenty of clients that have trucking or yellow goods and cats and Hitachis and things like that, we're able to claim a greater depreciation amount for the 2020 year and 2021 year than we have previously. So it's not the full tax deduction for new assets like we do if they're under 150,000, but we can claim in the first year of deduction 57.5% for new assets and 15% for second-hand assets that are to the value of over $150,000 or more. So if you're looking at investing in high-end plant and equipment, well worth your while doing it in the 2020 and 21 tax year, just because of an additional benefit that you receive up front. And then in subsequent years, you receive 30% of the written down value of the asset after the first year's 57.5% tax deduction. So for the $150,000 instant asset write-off, it can be new or used. Common question we've been getting this week. For the accelerated depreciation rates, to get the big depreciation amount of 57.5% for assets over 150,000, they're required to be new. Second-hand assets just get your general pooling depreciation deductions from there. So that's been the biggest calling card, I guess, for clients, and the biggest carrot that's been waved from a tax planning point of view in comparison to previous financial years. One of the little quirks that came about in this rule of the $150,000 instant asset deduction was that if your business was in a small business pool, and most of the people on the call here today will be, you have a closing pool balance from the previous year. Now that pool balance may be under $150,000. So what a pool balance is, it's the sum value of all of the assets you have purchased from the beginning of time, less what you've already claimed in depreciation. If that value is under 150,000 at the start of the financial year, then we're able to claim that amount in full, which is quite handy, because what that means is a lot of clients who are in that sort of income category of $100,000 to $300,000, they may find that all of a sudden this year they're getting quite a big deduction for their pool balance for the depreciable assets, and therefore they're not required to do any other further tax planning at all. And you might want to really think about that first before you then go and spend money on other things as well. So a couple of things out of assets. One is the instant asset write-off, and two is obviously work out what your closing pool balance was. You can get that from last year's tax return, and that could be an immediate deduction this year without having to lift a finger from there. Other tax planning tools that we see happen quite a fair bit, and we encourage clients to do. You can prepay expenses up to 12 months in advance and get a tax deduction for them today. We see that quite a fair bit with regards to rent for tenancies. You might want to prepay your lease, especially if you're renting it to a related party like your own super fund or to a different company of yours. You can prepay your rent up front, and that can get you a tax deduction in the entity that you need it to happen. You can also prepay any other expense which you think might happen during the year, up to 12 months in advance, such as lease payments with the bank. We also see our agricultural clients go into stock and station agents and put $50,000 into a prepayment account where they buy expenses. But it's quite common that you can prepay expenses and still get a tax deduction in this year, where you would have incurred the expense in the following years. That comes in handy, especially if this year is a bigger income earning year for yourself, and that you expect it not to be the same in following years, depending, obviously, this year, especially with regards to the increased volatility in business conditions. We're finding that profits may be up for 2020, but could be projected to be lower for 2021, especially if you're in the hotel, hospitality, some mining sectors where things aren't quite so certain in the 2021 financial year. You can also defer earning income until the following year. Now, be very careful with this one, because there are some income matching and income derivation criteria, but there might be a sale which you haven't quite closed off yet, and it may not go, for example, until the following financial year. Don't write the invoice for the 30th of June for something that you haven't sold yet. So, for example, the customer's coming to pick up the vehicle on the 5th of July. It's almost better for you to invoice it into the following financial year where the sale has taken place, rather than just throwing it at the 30th of June, because that's what your accounting system has done so in the past. So making sure you have the income in correct years is very important to make sure you're paying the appropriate tax in the right year also. You might be a project that's half done, for example, that you might usually invoice, but you might not be required to invoice until the 2nd of July. That can be handy also in making sure that your income is spread out over a few years, or also getting less taxable income in this financial year as well. Another one that employers can do without actually having to spend any money, and it's purely just by timing, is making sure that superannuation contributions are receipted by the superannuation fund prior to the 30th of June for both employees and your own contributions, so that you can get a tax deduction in this year. Reason why that's so important is what generally tends to happen is you pay your employees for the 2 fortnights in June, for example, and you might pay your superannuation contribution in July. Well, you only get a tax deduction for that superannuation contribution in the period in which you pay the contribution. So by simply bringing forward that payment until, for example, this Thursday, you're able to claim a tax deduction in this year rather than in the next financial year, which can help you out from a tax planning and tax saving point of view now, where you might need the cash in compared to previous years. You can also choose to organise invoice for expenses to be dated June rather than July or August. Once again, this comes about as part of the prepayment legislation, which is enacted as well. Tax deductions are based on the invoice date and not the payment date of the expense. So I could ring up today and order an expense. For example, I could order some stationery from one of the local suppliers here. Because it's an expense, as long as the invoice is in by the 30th of June, it's very important that we can claim a tax deduction in this year, even if it's on a 30-day account and we pay it in July. So the tax deduction is actually based on the invoice date rather than the payment date of the expense. One thing that a lot of our clients choose to do is make donations by the end of the financial year. So if you're a regular donator through the year, it might be handy to think about, okay, well, we'll bring forward our donation to the 30th of June to enable to get a tax deduction in this year, and then do that from now onwards. So simply by timing where your expense is at can save you tax in this financial year as well. If you run a business whereby you invoice customers and you've got customers that haven't paid you or are not looking like paying you, make sure at the end of every year that you review your accounts receivable ledger, that's people that owe you money, and that you write off any bad debts that are in your accounting records, okay? What happens is that from a tax point of view, any sales invoice, even though it hasn't been paid, is brought to account as assessable income in this financial year. So make sure we write off the bad debt in the correct financial year in which it occurred, rather than paying tax on that invoice now and writing it off next year, where you would be paying income tax in the 20 year and a deduction in the 21 year. So it's important to make sure you review the bad debts ledger every year and your accounts receivable ledger to make sure that all amounts in there are recoverable by your clients. Income protection insurance is fully tax deductible. It's another question we get quite regularly. However, life insurance and trauma insurance isn't tax deductible. So it's important to make sure that your personal policies are in order and that they're clearly separated out to ensure that we can receive a tax deduction for your income protection insurance, whereas your life and trauma insurance can be held inside your super, or they can be held outside your super. It's just going to be non-tax deductible. So always good to review your insurances every year. Got a client at the moment who's with another financial planner, and they've reviewed their insurances which have been deemed quite inappropriate based on their age and their income potential. So it's always good to get your house in order with regards to your personal insurances to make sure you're not either overinsured or underinsured as well. Ensuring that your stock values are correct at 30th of June is quite important also. We generally tend to find that, I'll probably say 25% of my clients do stock takes regularly. And it is quite an issue. Obviously, businesses always are struggling to find time to do stock takes, but everybody should be doing a proper stock take at the end of the 30th of June to make sure that their stock values are correct. If your stock value is higher than what it's actually worth or what's actually on the shelf, then you could be inadvertently paying too much tax simply because what's held as closing stock comes off the purchases that you make throughout the year. So you must always ensure that obsolete or old stock should be marked down to saleable values by 30th of June. That's especially so in the retail sector where you have old lines of clothing, also in the manufacturing sector where you have old lines of stock for old models, etc., where you have to discount them heavily. And each and every line of stock can be valued at the lower of its cost or its market selling or replacement value. So just keep that in the back of your mind that you need to review your stock sheets at the end of every year to make sure that we're not putting in too much stock on your tax return and making sure we're able to claim as much purchases as we possibly can. Another thing that we tend to find that doesn't happen quite so much is that you must ensure that you pay commercial salaries to family members, including children who are on lower tax rates for the work they perform. So the rationale behind this is that if you have a mum and dad, for example, who are earning $100,000 each, and they have a couple of kids who are 17 or 18 or 19 who work in their shops of a Saturday, and they just pay them cash in their hand or they pay them pocket money rather than through the books. What you could actually be doing is inadvertently paying more tax, because if you were to pay those children or family members on the books and via wages as appropriate and legal, then they won't be earning any tax until they earn $20,000 per annum. However, if they're not being paid on the books, you're paying that tax for them on your tax rates at a higher rate. So you must always ensure that you pay commercially salaries to family members just to make sure that you're getting every bit of tax deduction out of what they're working and what they're paying you. So it is quite a common thing that we review with all our clients to make sure that everybody that's working in the business is being paid appropriately. That's also from a work cover point of view, from an insurance point of view, but also from a tax point of view as well. And it's always good to review the market value of what they're earning compared to what they're being paid, especially if they're children as well. One thing that we do every financial year is we make sure we review the appropriate accounting structure for our clients when we do a tax review. And it's something that everybody should do every year, just to take stock and have a look back and go, am I in the appropriate structure? And is this the most appropriate structure from an asset protection point of view and from a tax point of view? For example, if you're a sole trader or in a partnership, the profits are taxed down at the individual tax rate. So if a sole trader is earning $180,000 a year, then he's being taxed right up to the top tax rate of 45% or 45 cents on the dollar. If you're earning 200 grand a year, you're actually not higher than what the appropriate top tax rate is. If that's the case, you really should be starting to consider a company structure with a flat rate of tax at 27.5% and paying yourself a wage from there of what you actually physically take out of the business. Company structures are the most popular structures at the moment, simply because of the lower tax rates, the asset protection that it affords. And trust structures are common as well. They were more so common quite a few years ago when you were able to distribute money to companies from there. But those tax concessions are being closed off over time. And what's more appropriate is that company structures with a flat tax rate of 27.5%, and then possibly having a trust as a shareholder where you can flexibly distribute income down to individuals, etc. from there. There are tax and stamp duty concessions which can apply when you roll over from an individual or a partnership into a company or a trust. So don't think, oh, it's going to cost me a heap of money. That can be the case, may not be the case. So it's always good to review it to make sure that you're in the appropriate trading structure for what you need at any point in time, which is always important, because if you get that wrong, it's already happened by the time we come to do your tax return. So we need to make sure that we're very proactive with that, just so we're sure that, hey, you're paying as least tax as you possibly can throughout that period of time. I haven't touched on superannuation at all yet. And superannuation it's obviously a financial advice, but it's also good from a tax deduction point of view, where you can pay money into superannuation and receive tax deductions. So the concessional contributions cap at the moment is $25,000 per annum. So that's the maximum amount that you can put into superannuation, whereby you receive a tax deduction for. So it's always good, especially later years in life, to make sure you maximize this as much as you can. So you've got a good retirement income to retire from. And it's also tax effective, because any income that's earned in a superannuation fund or by your superannuation fund is taxed at 15%. Whereas if it's earned by yourself, it could be taxed as high as 45%. So getting as much as you can in super from a tax perspective is fantastic in the long run, that's for sure. One thing that's changed this year has been the introduction of the unused concessional contributions cap. So whereby people thought, well, 25,000 was the maximum that I can claim in super every year. That's correct. But also you might be able to contribute more to used up previous unused concessional contributions that you didn't have. So for example, I might have only contributed $5,000 last year into superannuation. My cap is $25,000. So I can carry forward $20,000 from last year and contribute $45,000 into superannuation this year. This can go on for 5 years. So technically you could not contribute anything for 4 years, and in the 5th year, you could contribute $125,000 into super and get a tax deduction for it. This is a great piece of legislation, simply because if you have lumpy incomes like this, when income's low and you don't use up your concessional contributions cap, you can carry it forward to when your income's high, and you can bring your income down by paying, for example, $45,000 or $50,000 where you can afford it. When you can't afford it down here at the low end, then you don't need to worry about having to give that up. You can always catch it up later when it comes up higher again. This is the first year that we've been able to carry forward concessional contributions from a previous year. So don't think, oh, geez, I can do heaps. So if you contributed nothing last year, you can do 50 this year or up to that amount. If you're on MyGov, you can log into your MyGov account and on the taxation services page there, and it will actually tell you what your unused concessional contributions cap is. So everybody's cap's going to be different for the unused amount, but you can easily tell on your MyGov account what that is. Or if you use an accountant, you can always give them a call and they can let you know what it is as well. Superannuation contributions really have to be in by this Thursday to make sure that they're receipted by the fund the following Tuesday. So there's a sense of urgency on making sure super contributions are in. If you plan to do a superannuation contribution, and making sure that they happen as quickly as they can be between now and the end of June will give it the best chance of getting in by then. You can also do non-concessional contributions, but you don't get a tax deduction for them. So if you choose to go above the concessional contributions cap, that's okay. You just won't be able to get a tax deduction for it. So just keep that in the back of your mind as well from there. They're the main things that I wanted to cover off as far as tax planning and tax tips for this year. The key takeouts from it are essentially learn what your taxable income situation is now. Look at what tools are available without spending any money, which is essentially reviewing your structure, reviewing what expenses you can bring forward that you would normally do in July into June, learning what you may be getting from the depreciation pool, and also what you're able to do as far as prepaying anything that can really help out from there, or transferring income to family members who aren't earning as much money as well. One thing that has to be done, very quickly before the end of June is if you are in a trust environment, is making sure you have a trust distribution resolution done up. So that you are selecting who you choose your trust income to go to amongst family members. So if you're in a family trust, the income is not taxed at the trust level, it's taxed down below at beneficiary levels. So what we're currently doing at the moment is making sure that all trusts have a distribution resolution in place. And we're really making sure that we plan out these distributions so that everybody in the distribution chain is paying as least tax as possible from there. So if you're in a trust structure, just remember to do those by the end of this week as well.
Awesome.
Very much from screen. Cool.
Perfect. Peter, thank you so much. That was excellent. So we do have a couple of questions. We're coming into the question time. If you have a question, please feel free to just raise your hand and speak up, or you can put it in the chat. But I'm going to start with a couple of questions from Tanya Rutherford. So the first one, I'll start with the second question first, because it kind of relates to the super comment that you made before. So her question is, so when it comes to income protection, is that still actually tax deductible if it's held in your super?
No. So you can hold income protection inside your super or outside of your super from there, okay? If it's held outside of your super and you make a payment to your income protection insurer, that's tax deductible. If it's inside your superannuation fund, then your superannuation fund receives a tax deduction for it, and you receive a tax deduction for any contributions that you make into super itself, not for the income protection part of that. Okay, so a lot of people put it inside superannuation because they leave it in there. It's not costing them any money. It's held by their super, and their super takes care of that. That's okay. It's not as tax effective inside super because superannuation funds are only taxed at 15%. Whereas if you're earning, say, $100,000, $150,000 a year, or even $80,000 a year, you're being taxed at 32% per annum or 40% per annum. And so your tax deduction percentage is a lot higher than in super. But the flip side of that is that you've actually got to spend your money. Whereas inside superannuation, it's still your money, but it's your money for a later period of time in life. Does that make sense?
Awesome. Perfect. Okay, another question. With paying expenses, does it make or doesn't it make a difference if you are cash rather than accrual basis for payment date?
Yeah, so that's really from a GST point of view, where you're on a cash and accruals basis. There's not too many businesses that are on a cash basis for income tax these days. There were some quite very old STS rules, which really was sort of phased out back in the early 2000s. And we try to make sure that everybody's on an accruals basis for income tax so that you can physically receive an invoice and get a tax deduction for it in this year. So there's two concepts. Cash is when you pay the money and you receive payment for services rendered. And that's usually from a GST point of view when you do your GST returns. Accruals is when we come to doing your income tax return. And from that income tax return, we do it based on when sales were made and when purchases were made. So the GST concept and the income tax concept are two different things. If you're looking from an income tax point of view, if you have an invoice for it the 30th of June, we can put it in the 30th of June and claim a deduction for it.
Cool. Okay. So I'm going to ask a question next. If you have a question to ask, please just feel free. If you're joining us via Zoom, just raise your hand. There's a little hand icon at the bottom of your screen where it says reactions. You'll see that there's a thumbs up or a hand raise. Either we do, and you can just, or you can just speak up, or if you're on Facebook, joining us on Facebook, please feel free just to add your question in the comments and we'll read those out as I did for Tanya. So Peter, my question is, can you list just maybe 1 or 3 things that are really easy that we can do over the next, what did you say, 6 business days to help us, which is a pretty scary number, to help us save tax? What are the easiest wins for us?
Yeah, so the first easiest win, especially if you employ people, the easiest win at the moment, given it's so close, and if you do have cash, is to pay your employees superannuation contributions now rather than in July. That's a really quick, easy win because it's something that you're going to do in any case. You're just bringing it forward until this year. So that's always my first one. The second one is if there's any expenses that you're going to do sort of in the first 2 weeks of July, just go and do it today or the next week. If that means you're not doing it in July, okay, but do a big order. If you're in the manufacturing industry, for example, and you need a heap of consumables, purchase it now. For example, there might be some printing, some stationery, some advertising stuff, bonuses to staff, anything that you would normally do in July. If you can bring it into the next week and it's easy to do, that's from an expenditure point of view. That's probably the other one that I would really look at doing straight off the bat. And the third one is personal super contributions as well. Is pretty simple. Prepaying lease payments and prepaying rent, especially if you, like, your super fund owns your building, or you've got a related party landlord or something like that. Once again, it's easy to get rid of some money, but you would have to spend it in any case going forward from there. So we generally do try and make sure all those things are taken into account first, and then we go from there. Another one that we have seen a little bit is prepaying interest. So if you've got like a fixed loan for something, you can go to the bank and prepay a year's worth of interest. That's pretty simple. Takes you half an hour at the bank manager, do up some forms, things like that. They're probably going to hate me for saying that, but it's not too bad, and it's something you can easily do. So any sort of quick wins like that, we can still see clients sort of 29th, 30th of June getting some really easy wins. Just by arranging their affairs in a way that, hey, I can do this now rather than in July.
Yeah, awesome. Okay, so now if you have a question, please speak up, just unmute yourself and ask a question. I like what you said before, easy ways to get rid of money. That's always easy. That's an easy thing to do, get rid of money.
It's an accountant thing.
Yeah.
Yeah, you see it all the time. The other thing is, Elise, is stock take. I've been really onto people about stock takes because, especially with regards to the current environment with coronavirus and stock levels and things like that, make sure that your stock values on the books are accurate. If what's in your MIRE file, your zero file, is 50,000 over what it actually is, it's actually costing you roughly about $18,000 in tax, just because these figures are wrong. So it's not costing you any money. It's just making sure that the records are accurate. And by doing that, it's obviously given to your accountant accurately. And therefore, what goes in your tax return, obviously you're going to pay less tax, but it's also a more reflective figure of what it actually is as well. So we do see quite a fair few inventory records get out of hand a little bit. So making sure people plug that back in is really quite important as well.
It's a great time of year to get all of your, I almost want to say, spring cleaning, housekeeping things done, right? Even though it's winter for us, it's a really good time in business just to get your house clean and know exactly where you're at with everything.
Exactly, and we're finding that a bit with obviously in April, when some businesses were shut or had to go home and things like that, that there was a lot of systems work being done by businesses. There was a lot of that sort of housekeeping being done, which is really sort of, businesses will come out of that, even though they've had a bit of hurt in these sort of 6 weeks to 8 week period. They'll come out of that very strong from a systems point of view and a records point of view, which is going to stand them in good stead for the very long term. So yeah, very much so, especially if you're a bit quiet in the next few weeks, spend that time to get your house in order is always good. And just said, spring cleaning is a good way of putting it as well.
Love it. Okay, any questions for Peter?
Anything easy?
How can you save tax? Any burning questions? Let me have a quick look at Facebook. So if you're on Zoom, just feel free, unmute yourself and just hop in
Peter,
the chat.
it's just Miles here. One question about we're talking about structures there before. With the trust, can they utilize FMDs, farm management deposits?
That's done at an individual level, Miles. So do you operate a farm business out of a trust? Is that correct?
Yeah, partnership at the moment, but looking at a new structure.
Yeah. So if you're in a trust, you can utilize FMDs because the trust income is actually taken down into the individual beneficiaries, much like what your existing partnership structure does. So providing you still receive trust distributions from that trust and you're actively involved in that trust still, you can do FMDs. That's exactly right. So that's why, and my slide said trusts for primary production are more preferred than companies. It is because of these primary production concessions, farm management deposits, in-force sales, small CGT concessions, etc. But yeah, if you're in a trust, the beneficiaries can do FMDs, definitely.
So would you, for primary production purposes, would you lean more towards a trust than just a straight partnership?
Yes, definitely. Yeah, from that point of view, there's a lot more flexibility. There's also a lot more asset protection if you have a company as a trustee rather than individual partners. If you're in a partnership, then the partners are joint and severally liable for everything that happens. Whereas if you're in a trust structure, then you do have a level of asset protection in there as well. Also, what you can do is you can choose to distribute to members on and off. Whereas if you're in a partnership, the distributions are fixed, usually 50-50 or 33-33-33. So trusts are a lot more flexible for primary producers. And primary production is an area where I guess income goes up and down quite a fair bit, doesn't it, Miles? Is that what yours does, year on year sort of thing, like based on seasons and things like that?
Yeah, that's right.
So why we would use a trust is like, for example, if it's a big year, then you might be wanting to distribute out to a few family members, say some kids or some spouses and things like that, if you've got high income, and use farm management deposits. But if you've got a low income year, then you might only want to distribute to yourself. So you're able to flexibly distribute the income where we need it to. Whereas if you're in a partnership and you're earning $600,000 a year, for example, you can only divide it by two partners, then you're each taxed at 300 grand. Whereas if all of a sudden you're in a trust and you can divide it by spouses, you can divide it by 4 very quickly. Tax at 125 grand a year is a lot less than the higher amount, simply because you're not in the top tax rate from there. So most of our primary producers, I'm not going to say all of them, but most of the primary producers that are sort of young or have got families and spouses and that, they're generally tending to move towards trust, that's for sure. So it's something definitely to consider.
Right now, too easy. Thank you.
Awesome. Thank you for the question, Miles. Any other questions? Just as I said, unmute yourself and feel free to speak up. If you're on Facebook joining us and you have a question about how to save tax legally or any other tax planning, please feel free to pop a question in the comments and we'll read that out from Facebook. So you see my eyes darting all over the screen. That's what I'm doing. I'm just monitoring the Facebook feed as well. Any other questions? Everyone has their tax planning under control. Peter, you must have done such a good job. We don't have questions. We'll give it like, pardon, you go.
Yeah, I do have one quick thing, especially if you're individuals, for example, so mum and dad. I do come across this a bit, and I came across this with my own parents as well. Lots of mum and dads have joint bank accounts with their money in it, okay? And it's not really applicable at the moment because interest rates are very poor. But for example, if mum and dad have a couple of $100,000 in a bank account, it was returning interest of quite a substantial amount. So 200,000 at 4% is about $8,000 a year. If mum and dad held that in joint names, then it was assessed at $4,000 for dad and $4,000 for mum. However, if dad was working at the mines and he was on 130 grand a year, he would be taxed at 40% for that. If mum had just had a bub and wasn't working, or was working part-time or casually, and she was on no tax rate, then she wasn't being taxed anything on that interest, okay? So what you could do, simply by moving all of your money from a high income earner into a low income earner, that example is pretty basic, $200,000 on a term deposit, and you move it into a low income earner, you could save yourself 2 grand tax a year just by moving it from being in a joint account where it's mum and dad into a sole account with a low income earner on it. Once again, there's nothing involved in it. It's just a matter of next time it renews or moving the money over from one account to another. We tend to find that a bit, especially for older generation, if they get inheritances from mums and dads and things like that. Brent and I had a big one here with shares where we transferred a heap of shares over from one individual to another simply for longer term tax savings, just to make sure that everyone's incomes were the same. The last thing you want if you're a mum and dad is to have mum earning $10,000 and dad earning $80,000 based off your investments forever and a day, because it quickly compounds when you start locking those investments in for 20 years. So it is always important to make sure that happens from there.
Awesome. Excellent. Thank you so much for sharing that. Very, very interesting and important information. Anyone, a question from anyone? Any questions? Let's have a look. Any questions on Facebook? Peter, I think that you've done a phenomenal job.
Oh, thank you.
Everyone's questions are answered. Is just finally, just before we go, is there anything else that people do ask you that we haven't covered yet? I don't think there is. I think we've done a really good job covering everything, but is there any other piece of wisdom that comes to mind?
No, I think I think that was my bit of wisdom at the end there.
Yeah.
The recap. Yeah, no, I think I've covered everything on my notes here. So yeah,
Perfect.
Just always the big message is review your current situation, work out where you're at, and then go from there. Don't just run in and do all this stuff. You need to review where you're at first. That's the key message. Yep.
Excellent. Peter, thank you so much from Canars Chartered Accountants. Thank you so much for sharing your wisdom and your insights around tax planning and tax saving this year. Yeah, I agree with Tanya. She's just given you a hand of applause. I agree with that. If anyone else found that really useful, just go to the reactions at the bottom of your screen and give Peter a hand or a thumbs up. Yep, there we go. Everyone found that very, very useful. Thank you, Peter, so much. And of course, join us next month for our next Lunch and Learn. Keep an eye on your email if you're on our newsletter or on our Facebook page where we share all of the information. We would love to see you again. And again, also, you can join us on Thursday for our next Hub Live. We look forward to seeing you then. Thanks, Peter. Thank you, everybody. See you later.
Guys, thank you.